Welcome to another Infographic Instant with Brian Michael. In this episode, we're going to be showing why China has not been the most rewarding country in the world in terms of its shadow banking. Before we talk about the infographic, we should describe where these data come from. The first set of data, looking at the securitization premia, that's a big word, and basically what that looks at, it looks at the difference between the return on assets and return on equity. So imagine that you have a set of assets, machines, whatever assets, producing revenue, money. And we know that over time, any equity, any papers basically that represent the value of those assets must reflect over time the value of those assets. If the company's machine only makes $100 a year, we know that other things being equal, the equity in that company eventually also has to only produce $100. So it's one of the iron laws of corporate finance is that over the long run, the papers, the securities that represent the assets eventually have to give out the value of those assets themselves. So the other concept that we invoke in this infographic is that of the lending spread. And that basically looks at the money, the profit that banks make, and that is the difference between the rate at which they borrow and the rate at which they lend. And so that's pretty commonsensical. Now, in this infographic, we compare the two to see which banking sector was more profitable in emerging markets. Was it the formal banking sector, where banks borrowed money from, let's say, the central bank and lent it out again to businesses? Or was it this informal shadow banking sector, which basically wrote securities on various assets and sold those securities as quasi-loans in order to earn a spread on the difference between what it paid for those securities and what it sold them out at again? And what we find is that we find three groups of countries. I guess we can call them the fast growers, the plotters, and the slow growers. Turning our attention now to the infographic, we see that the fast growers have included Turkey, Saudi Arabia, South Africa, and to a lesser extent, Brazil. Turkey is particularly noteworthy given a relatively rapid growth in its equity markets and, of course, in the domestic economy overall. The spread between the return on assets and the return on equity in Turkey over the time period that we look at is quite startling, exceeding easily 35%. The other point I would like to draw your attention to is the difference between the lending spread and the securitization premia in Brazil. Brazil is the only country where banks seem to have made more money than shadow banks during the time period we looked at, which is very instructive. And that's instructive because if policymakers want to give incentives to banks to lend out more money, then of course the rate of return has to be higher in the banking sector than in the informal sector. People go where the profits are. Turning our attention now to those plotters, those medium growth companies, we see China, Chile, India, and Indonesian companies basically forming part of that group. What's noteworthy is that in the popular press, everyone talks about China as the big grower in terms of shadow banking. And yes, that's been true given just the sheer size of the Chinese economy. However, when we look at the profitability of that shadow banking, we see that someone would have been much better off engaging in shadow banking in South Africa or Turkey than they would have in China. So that suggests that China is not this land of milk and honey for shadow banking that many in the popular press have portrayed it to be. India, Indonesia, and to a lesser extent Russia also follow the same pattern, with the difference in return on assets and return on equities stabilizing for all of these countries at around 15%, give or take. The last group of countries, Mexico, Argentina, Singapore, to a lesser extent Russia, depending on your judgment, represent those laggers. Those are countries in which the companies have only earned about 10% spread between the return on assets and the return on equity. Granted, 10% is still not bad at all. If you put $100 into assets and you're able to take $110 out continuously over time, in terms of selling those equities in private placement transactions, you're still doing much better than if you just put your money in a current account in the US or in Europe. However, compared with the differences in Brazil and Turkey, we see that those markets have not been as attractive, namely Mexico, Argentina, Singapore, as some of the fastest growers. So aspiring and current shadow bankers should take these trends into account when deciding where to securitize and where to sell these types of shadow banking transactions. This has been another infographic instant with Brian Michael.